Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Matt, the Lumberjack Landlord. How you doing, buddy?
I'm doing awesome. Excited about that last video because I really do believe wholeheartedly that's a game changer.
Oh,
Having
yeah.
a business card, game changer.
No, I think the buy box, being different. I think real estate agents, brokers, investors all need it. If you have a brand, you can use the one we did for 200. I think most people are fine at $15. Why spend it,
Yeah,
right?
no,
Especially
totally
today.
agree. Yeah, and the other thing too is like evaluate it. Like
Yeah,
check out the video of that I evaluated them. Check out and maybe you find that you need to spend the 200. Maybe you do.
maybe you do.
We
Yeah.
did. We spent a lot of money on our brand.
Yeah, I actually will. I got four, right? Two for me, two for Olivia. So
That's awesome.
there we go.
So good.
$800. Thank you very much. I want to do here is kind of connect two conversations I've had over the last week with something you, Dion, and I have talked about for the last couple of months. So let me set this up. We have often thought that when mortgage rates got to 6%, that the housing market would change.
Yep.
Right. That's and just so we're clear, that 6%, 30-year money, owner rock.
It is. Yep.
Okay. I had a conversation with Matt, the mortgage guy, last Wednesday. It is very clear that consumers are doing what consumers do. They are still being active in the real estate market, right? We saw pending home sales up. We saw new home sales up. And they're doing something, frankly, logical. 6% is too expensive. I'm going to go get a 5, 7, or 10-year ARM. I don't approve them. Certainly, if you're an investor, that's not what we do, but who cares? That's the reality is setting in. People are getting ARMs today at 4 1/4, 4 3/8.
Yeah.
So yesterday, I have a conversation with Greg Dickerson because he and I have often said game over in housing if it ever got to 6. During that conversation, we kind of went around the fence a little bit. And I think we've come to the realization that interest rates have to go to 8%, 30-year money fixed, to destroy housing and to really cause a crash, because buyers, homeowners, will just not move to the 30-year. They'll go to the 7-year or the 10-year ARM. And if that ARM is 2 points, again, we're using rough numbers here, lower than the 30-year money, the 30-year has to be at 8 to cause the ARM to be at 6.
Yeah.
And maybe that's when this thing all blows up. Because again, if you can get money at 4.5, that's a really good rate. It's not 2 and it's not 30-year fixed, but 7, 10-year money at 4.5. So I think rates have to go much, 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 much higher. And
yeah, I mean, I think we talked about we would start to see it crack at 6. So I think it has cracked at 6. I don't think it's crumbled, but it's cracked. I think 7 and 8. But here's the thing: I think that the area that I think is being missed is that when those rates start to affect the values of the homes, that's when things, because a lot of people are not just net looking, right? They're having to sell and look. And if that's the trade up buyer, like you and I have talked about, the move up buyer, they're not going to get as much for their first house anymore.
Right.
They're going to have to pay that much more for this house because it's a different note and it's much more expensive. So yeah, I think that's probably right. I mean, I think that 6, we thought that it would crack, and it did. It's cracked. We're seeing much fewer transactions. I talked to Beth Traverso, who is based just outside of Seattle. She watches both of our channels. She's been in the game for 20 years, an investor as well. She's actually seen stuff that was listed for 1.4 that was at 1.4 and sold in those neighborhoods at 1.4 in February and March, and is now priced at 1.2.
Oh, wow.
So she's actually seen that decrease. So I think certainly on that higher end stuff where you're much more susceptible to, 6.5% of $1 million loan, as opposed to, or the 300 bips or the 3 percentage point margin. That's where it's really starting to affect people, where you're going to have to buy less house or the price has to come down. So I think we're rolling that wave over. I think it's housing. I think you're right.
I think it's farther away than even I thought. Right.
Really?
Yeah. Because again, for me, there's really two markets, right? There's the first time home buyer, and then there's the move up buyer. I think the move up buyers, I think they broke it. I think supply in the move up's done. And that really hurts the first time homeowner, right? That's why you're seeing most markets, including Phoenix, including Vegas, which I called the Canaries dead in Vegas.
Yeah.
The low end, the affordable stuff still moving,
Yeah.
right?
Yep. It
But
is. Yep.
most of the market is just stacking.
Yeah.
But there's still that sliver of affordable that's still selling. So I really do. So what does this all mean to me? I think the Fed has a lot longer rate cycle going because again, just the reality, right? If you look at where wealth is held, it's held in real estate by most people. And what I've now come to realize is a 6% 30-year mortgage is going to crush transactions, but it's not going to slow really much of housing appreciation, which it has to stop. I want to see 5 years of no growth. I'm not calling for a crash. I've never called for a crash. I'm not even calling for a correction. I just want it to stop going up 20% a year. That's a problem.
Yeah, I think that. Okay.
I was going to say, so I think the Fed, a lot of people are, including Dion, is calling for the Fed to pivot this year.
No way.
I don't see it.
No.
I think they're going to have to go higher than even I thought 6 months ago. Because again, if real estate has all the wealth and you've got to crush demand and break the animal spirits and all that nonsense, you've got to get arms to 6%, not the 30-year, which is what I thought it was. You got to get arms there. So you got what, 2 more points at least? Oh, it's scary to think about.
Yeah. So in 07, 08, we had something like 13.4 million arms.
Yeah, it was 50. It was 52% of arms originated or loans originated were arms.
And this year we have around 2 million.
Yeah, vastly.
So guess what's going to happen? It's going to be a couple of year run up.
Mm-hmm.
So maybe 2020. But Mike, what does this mean for us for values? Values are going to slowly decline. If they decline, they will slowly decline.
The growth rate will slow.
Yeah, I certainly expect a 10% decline before the year 2025, says my shiny dollar.
Yeah.
But that's what, and I think that, but that's what we're going to have to get to, right? And that means that we're going to have to not only break the 30-year fixed idea, but we're also going to have to break the adjustable rate idea to 6. But here's where I think that the value of this is. Those are still 1-year teasers. They're not 2-year teasers. So they're 1-year teasers, 2-year teasers, maybe some 3-year teasers. I think that there's enough runway with the number of adjustables that are being done now where it still happens before 2025 where people aren't paying.
No, see, that's maybe I didn't say it here. All arms,
4 years, 5 years.
No, so the arms today, there are no teasers. I mean, maybe there's a couple, but the arms that are being done today, again, according to a mortgage broker, several, 5, 7, and 10. 5 is the shortest.
Okay, 5. Okay. Kicking that can down the road. Boy, we sure are making a couple of those channels out there look real stupid.
Yeah.
You don't understand. There's no way it can go but down. You don't understand. It's math. Yeah. So I think that will continue to happen as the market continues to pivot. They continue to make products that make it so they can stay in business and they can keep things afloat. Government does exactly the same thing. Yeah. But if you think rates are slowing down, you're nuts. Because honestly, Powell and those guys, they're at the point now. They don't care about the stock market tanking.
No.
They don't care. They don't care if Bitcoin goes to 4. No, doesn't matter.
No. Yeah. So really what I'm taking, and it started with Matt, it went to Greg, and now this conversation. For me, housing really starts to slow down when the arms get to 6%. I did not appreciate that. I did not make the connection. Heading into this year, arms were 2% of origination. They are now 10 and increasing.
Yes.
But again, these arms are different. No 6-month teaser, no 12-month teaser. These are 5, 7s, and 10s. If you can get the average tenure, again, heading into this is 8 years in a home. You get a 10-year arm at 4 and 4.5 instead of 6 and an 1/8. It's actually affordable, right? Comparatively speaking. So yeah, I don't think housing is going to slow down nearly enough. And I think the Fed's going to see it and they're going to have to keep raising rates. I think the Fed housing cannot keep going up double digits. It has to flatten out or the whole thing breaks. So I think rates are going up much higher than even I expected.
For those of you who are sitting on the sidelines and waiting, whoops.
Yeah.
Yep. This is what this basically means is they just kicked the can further down the road. There's no crash imminent.
No, it's certainly not.
World War III. Yeah. World War III changes that, like major catastrophic world events change that, of course.
Yeah.
But outside of that, like just monetary policy, the fact, Mike, did you ever think that after what was experienced in 08 and 09, did you ever think that adjustables would be back above 10% of loans that were being done?
No. No, I mean, the
Me either.
scar and the damage that was caused.
Yeah.
Oh,
We know that this is the beginning to the end, but what we also know is it took like 3 years.
yeah. Because the arm origination's not the problem.
Right.
It's the term.
The reset.
It's
Yeah.
the reset.
Yep. And so here's the thing. So I'm talking to, banks consistently. I own some commercial stuff.
Mhm.
And so in talking to them, they're actually doing, because they're not busy with applications, because commercial debt starts off as adjustable. It's
Yeah.
a 3, a 5, a 7, a 10.
Yep.
10 is really expensive right now. PS, by the
Sure.
way,
Yeah. P.S.
it's quite pricey. But you look at the resets, a lot of resets are now happening and their rates effectively double.
No, I know plenty of investors who are in loans and frightened about the resets, because you do that into rising cap rates, rising expenses, lower NOI. Ouch.
Yeah. Yep.
Ouch.
It gets expensive. I mean, you're going to go from a building making, 10 grand a month to 2 grand a month.
Yeah.
And that means that you can't afford all the things that you need to afford in order to keep that thing running.
Yeah. Well, we're going to try to sneak in a 4th episode that's really important. So where can people find you?
Lumberjack Landlord on YouTube and Instagram. Check out the new review series, the hands-on stuff. And it's on the channel. And then tonight, 7 p.m., we're honoring Dion with his trip to Alaska. We're honoring that with still doing his live stream on my channel.
That is awesome. Have fun with that. Hours and hours of questions. I look forward to that. Thanks, buddy.
Anytime.